ExamPrep.School. Missouri Life Insurance Producer Exam, Exam Code 50. There are 4 practice exams in this series. This video covers Practice Exam 1. The first 20 questions are free. In this video, we will be covering the following major categories for Practice Exam 1. Common to all lines. Completing the application, underwriting, and delivering policies. Life provisions, riders, options, and exclusions. Missouri Life Specific. Retirement and other insurance concepts. Types of policies. Let's walk through the format. I'll read each question and its choices. Let's get started. Question 1. Which of the following best describes the premium structure of a level term life insurance policy? A. Premiums remain level but refund upon policy expiry. B. Coverage amount decreases while premiums remain level. C. Premiums increase each policy year based on attained age. D. Premiums remain constant for the entire policy term. A countdown circle appears in the top right. Once it completes, the answer is revealed. You can pause at any time if you'd like longer to think. If you'd like additional practice covering more topics, see the description for our book. The correct answer is D. The defining characteristic of level term life insurance is that the premium amount stays the same throughout the coverage period, providing predictability. No refund or automatic increases apply. Reason A is not correct. A refund feature is specific to return of premium policies, not standard level term. Reason B is not correct. A decreasing benefit policy has a level premium, but a declining death benefit, not the constant benefit of level term. Reason C is not correct. Annual increases tied to age describe an annually renewable term rather than level term. Question 2. A decreasing term life policy designed for mortgage protection is characterized by which of the following? A. Premiums decrease annually while the death benefit stays level. B. Death benefit declines over time based on a predetermined schedule. C. Death benefit increases to offset inflation on the mortgage. D. Premiums remain level and death benefit is paid only if the mortgage is outstanding. The correct answer is B. A decreasing term mortgage protection policy features a death benefit that decreases on a scheduled basis, matching the declining mortgage balance over the coverage period. Reason A is not correct. Premium reductions are not a feature of decreasing term. The benefit, not the cost, declines. Reason C is not correct. Increasing the benefit for inflation adjustment describes an inflation-indexed policy, not standard decreasing term. Reason D is not correct. While premiums may be level, the hallmark is the declining benefit rather than coverage conditional on mortgage status. Question 3. Which characteristic is unique to an annually renewable term life insurance policy? A. Premiums are paid in a lump sum at inception. B. Premium remains level for the entire coverage period. C. Death benefit decreases over time according to a schedule. D. Premiums increase each policy year based on attained age. The correct answer is D. An annually renewable term policy is renewable each year without evidence of insurability, and premiums reset annually, increasing based on the insured's attained age. Reason A is not correct. Lump sum payment is not a feature of any standard term designed for annual renewal. Reason B is not correct. Level premiums throughout a multi-year term describe level term, not annual renewal. Reason C is not correct. A scheduled benefit decline is a feature of decreasing term rather than annual renewability. Question 4. What distinguishes a return of premium term life policy from other term designs? A. Death benefit increases automatically with periodic resets. B. Premiums decrease each year while death benefit remains constant. C. Provides cash value accumulation during the policy term. D. Refunds all paid premiums if the insured outlives the policy term. The correct answer is D. Return of premium term policies refund the total premiums paid if the insured survives the term, distinguishing them from standard term designs without a refund feature. Reason A is not correct. Automatic death benefit increases describe graded or adjustable term, not return of premium designs. Reason B is not correct. Annual premium decreases describe specific declining premium term variants, not return of premium. Reason C is not correct. Cash value accumulation is a feature of permanent life, not term with refund. Question 5. After 10 years under a 15-year level term life policy, the insured elects to continue coverage by exercising the renewable provision. Which outcome applies under that provision? A. Coverage is reinstated for another level term without proof of insurability at a higher premium reflecting current attained age. B. Policy is converted to a permanent plan with a new cash value based on the original level term rates. C. Coverage extends as extended term insurance using accumulated cash value at no additional premium. D. Insurer automatically issues a new level term policy with identical premium and benefit amounts. The correct answer is A. The renewable provision allows continuation of term coverage without evidence of insurability, but requires premiums to be recalculated based on the insured's attained age. Reason B is not correct. Conversion to a permanent plan is a feature of the conversion privilege, not the renewable provision. Reason C is not correct. Extended term insurance uses non-forfeiture cash values, which is separate from renewing coverage. Reason D is not correct. Premiums under a renewable provision are not identical. They increase to reflect attained age. Question 6. A policy owner purchased a 20-year term life contract with a conversion privilege that must be exercised within the first 10 policy years. At policy year 12, the owner requests conversion to permanent coverage. Which statement is correct? A. Conversion request is denied because it was submitted after the contractual conversion deadline. B. Insurer may approve conversion only with evidence of insurability since the period has lapsed. C. Coverage automatically renews for another term until conversion is completed within 5 years. D. Conversion to a paid-up permanent plan is available without further underwriting beyond the time limit. The correct answer is A. Once the conversion deadline in the contract is passed, no further conversion to permanent coverage is allowed under that provision. Reason B is not correct. Evidence of insurability cannot reopen a conversion window once the contractual deadline has passed. Reason C is not correct. Automatic renewal of term coverage is separate and does not extend the conversion window. Reason D is not correct. Paid-up conversion is not an option under term contract conversion privileges after the deadline. Question 7. Under an ordinary whole life policy with fixed premiums, premium payments cease when which of the following conditions is met? A. The policy's cash value equals the face amount. B. The insured attains age 100. C. The insured's death occurs. D. A dividend is declared by the insurer. The correct answer is B. The correct answer is that premium payments under an ordinary whole life policy are guaranteed level and payable until the insured reaches age 100, at which point no further premiums are due even though coverage continues. Reason A is not correct. Cash values grow over time, but reaching face amount does not terminate premium obligations under an ordinary whole life policy. Reason C is not correct. Coverage continues beyond the insured's death only in terms of benefits paid. Premium payments do not continue past age 100 in any case. Reason DI is not correct. Dividend declarations do not affect the guaranteed fixed premium payment schedule of an ordinary whole life policy. Question 8. Which feature best describes a limited pay whole life policy? A. Premiums increase at predetermined intervals during the payment period. B. Level premiums are payable only for a specified period, after which no further premiums are due but coverage continues for life. C. One single premium payment suffices to fund the policy. D. Premiums are adjustable based on the insurer's investment performance. The correct answer is B. The correct answer is that limited pay whole life features level premiums paid over a set number of years, after which the policy remains in force without additional premium payments. Reason A is not correct. Premiums in limited pay policies do not increase. They remain level until the end of the payment period. Reason C is not correct. A single premium policy is funded with one lump sum, unlike limited pay policies which require multiple payments. Reason D is not correct. Adjustable premiums describe universal life policies, not limited pay whole life. Question 9. A single premium whole life policy is characterized by which of the following premium payment structures? A. Level premiums payable until the insured's age 100. B. A single lump sum payment at policy inception. C. Flexible premium payments varying with cash values. D. Level premiums over a limited pay period. The correct answer is B. The correct answer is that single premium whole life requires one lump sum payment at the outset, fully funding the policy without further premiums. Reason A is not correct. Level premiums to age 100 describe ordinary whole life, not single premium funding. Reason C is not correct. Flexible premium options are a feature of universal life, not single premium whole life. Reason D is not correct. Limited pay refers to multiple payments over a fixed term, unlike the single payment of a single premium policy. Question 10. Carlos owns a participating whole life policy and recently used his dividends to purchase paid-up additions. How will this election affect his policy's cash value accumulation? A. Cash value will increase only by the guaranteed minimum interest rate. B. Cash value will accumulate based solely on the original face amount. C. Cash value will grow faster because paid-up additions add to the cash value base. D. Cash value growth will be deferred until the paid-up additions are fully paid. The correct answer is C. Using dividends to buy paid-up additions creates small paid-up policies that immediately increase both the death benefit and cash value, accelerating accumulation beyond the guaranteed schedule. Reason A is not correct. Dividend purchases of paid-up additions involve more than just the guaranteed interest rate and yield additional cash value. Reason B is not correct. Paid-up additions expand the cash value base rather than keeping it fixed to the original face amount. Reason D is not correct. There is no deferral of cash value growth when paid-up additions are purchased. Growth is immediate. Question 11. Mary purchased a whole life policy with a guaranteed insurability rider. Which situation qualifies her to increase coverage under this rider without providing evidence of insurability? A. At any time as long as she has paid all premiums. B. Unspecified option dates or qualifying life events without evidence requirements. C. Only after receiving written notification from the insurer. D. If she completes a new medical examination at the insurer's request. The correct answer is B. A guaranteed insurability rider allows additional coverage to be purchased at predetermined option dates or specified life events such as marriage or the birth of a child without requiring proof of insurability. Reason A is not correct. Coverage cannot be increased at any time, only at the rider's specified option dates or events. Reason C is not correct. The rider does not depend on insurer notifications but on contractually defined dates and events. Reason D is not correct. A medical examination is not required when exercising a guaranteed insurability option. Question 12. Within the flexible premium feature of a universal life policy, the target premium refers to A. The insurer's recommended premium amount to maintain the policy for the insured's lifetime. B. An extra premium needed to satisfy the IRS corridor at a given time. C. The minimum premium required to cover only the monthly deductions. D. The maximum premium allowed before the policy becomes a modified endowment contract. The correct answer is A. The target premium is the insurer's guideline payment, intended to keep the policy in force for the insured's lifetime without overfunding or triggering MEC classification. Reason B is not correct. The corridor relates to the required death benefit to cash value ratio rather than guiding premium payments. Reason C is not correct. The minimum premium only covers monthly deductions and may lapse if cash value is insufficient. Reason D is not correct. The modified endowment contract threshold is based on cumulative premium limits, not the target premium. Question 13. Under a universal life policy's monthly deduction schedule, the mortality charge is typically calculated by A. Applying the insurer's mortality rate at the insured's attained age to the policy's net amount at risk. B. Multiplying a flat per policy fee by the number of years in force. C. Calculating a percentage of the policy's accumulated cash value. D. Tying it to the amount of premium paid in the prior policy year. The correct answer is A. The mortality charge is based on the insurer's published mortality table for the insured's current age multiplied by the net amount at risk. Death benefit minus cash value. Reason B is not correct. Charges are age-based and risk-related, not a flat fee over time. Reason C is not correct. Charges are not a percentage of cash value, but of the net amount at risk. Reason D is not correct. Mortality deductions are independent of past premium payments. Question 14. The corridor requirement in a universal life policy exists to A. Ensure accumulated cash value does not exceed a set proportion of premiums paid. B. Limit the insurer's maximum permissible mortality charges. C. Maintain IRS, prescribed minimum death benefit to cash value ratio for tax advantages. D. Guarantee a minimum cash value at policy maturity. The correct answer is C. The corridor requirement mandates a minimum difference between death benefit and cash value according to IRS rules, preserving the policy's income tax advantages and preventing classification as an investment contract. Reason A is not correct. The corridor governs death benefit relative to cash value, not premiums paid. Reason B is not correct. Mortality charge limits are separate regulatory concerns, not part of the corridor. Reason D is not correct. Cash value guarantees are determined by contract provisions, not the corridor rule. Question 15. Marisol owns an interest-sensitive whole life policy that guarantees a minimum interest rate of 3%. The insurer declares a current interest rate of 5.5% for this policy year. Which rate will be credited to Marisol's policy cash value? A. The insurer's portfolio yield net of expenses, which could differ from the declared rate. B. 3.0%, because the guaranteed minimum always applies regardless of the declared rate. C. An average of the declared rate and the guaranteed minimum, resulting in 4.25%. D. 5.5%, since the declared rate exceeds the guaranteed minimum. The correct answer is D. The credited interest equals the insurer's declared current rate when it is above the guaranteed minimum. Only if the declared rate falls below the guarantee does the minimum apply. Reason A is not correct. The credited rate is the declared rate, not directly tied to the insurer's net portfolio yield. Reason B is not correct. This ignores that the declared rate applies when it exceeds the guaranteed minimum. Reason C is not correct. There is no averaging of rates. The cash value uses either the declared or guaranteed rate. Question 16. Under the terms of an immediate annuity, income payments must begin no later than which of the following timeframes after the purchase date? A. 30 days from purchase date. B. 60 days from purchase date. C. 6 months from purchase date. D. 1 year from purchase date. The correct answer is D. Income payments under an immediate annuity must commence within 12 months of the initial premium payment. This distinguishes an immediate annuity from a deferred annuity, where payouts begin after a longer deferral period. Reason A is not correct. Requiring payments within 30 days is shorter than allowed. The maximum window for an immediate annuity payout is 1 year. Reason B is not correct. Starting payments within 60 days is earlier than necessary. Immediate annuities permit up to 12 months before payouts must begin. Reason C is not correct. A 6-month start is sooner than the maximum allowable period of 1 year for an immediate annuity. Question 17. A 44-year-old policyholder with a non-qualified deferred annuity in the accumulation phase has contributed a basis of $50,000. The accumulation value has grown to $65,000. She withdraws $10,000 from the contract. How is this withdrawal treated for tax purposes? A. The entire $10,000 distribution is treated as a return of basis free of taxation. B. The distribution is treated proportionally as 23% gain and 77% basis for tax purposes. C. The distribution is considered gain first, so the entire $10,000 is taxable as ordinary income. D. The distribution is exempt from income tax, but subject to penalty if under age 59 1/2. The correct answer is C. The correct answer is that non-qualified deferred annuity withdrawals are taxed under the LIFO method, with gains distributed first and taxed as ordinary income. Reason A is not correct. Treating the entire amount as return of basis is incorrect because non-qualified annuities use the LIFO rule to tax earnings before recovery of basis. Reason B is not correct. The prorated method applies to life insurance contracts, not to non-qualified deferred annuities, which follow LIFO in the accumulation phase. Reason D is not correct. Withdrawals are not exempt from income tax. They are taxable as ordinary income and may incur a penalty, but are not tax-free. Question 18. Which policy provision stipulates that only the policy document and the completed application constitute the contract, excluding all other external statements? A. Free look provision. B. Reinstatement provision. C. Entire contract provision. D. Grace period provision. The correct answer is C. This provision defines the scope of the contract as limited to the policy and application, preventing any external documents from altering coverage. Reason A is not correct. This provision allows cancellation within a limited period and does not define contract documents. Reason B is not correct. This provision governs restoring lapsed coverage, not the contract's document scope. Reason D is not correct. This provision addresses premium payment extension, not the contract's composition. Question 19. Which clause of a life insurance policy contains the insurer's promise to pay benefits upon occurrence of the insured event? A. Insuring clause. B. Consideration clause. C. Ownership clause. D. Beneficiary designation clause. The correct answer is A. The insuring clause sets forth the insurer's promise to pay the death benefit subject to policy terms. Reason B is not correct. This clause addresses the exchange of premiums and statements, not the coverage promise. Reason C is not correct. This clause defines rights of policy ownership, not the payment promise. Reason D is not correct. This clause identifies who receives proceeds, not the insurer's coverage promise. Question 20. What requirement does the consideration clause of a life insurance policy establish? A. Consent of beneficiary and insured signatures. B. Assignment filing and endorsement approval. C. Premium payment and insured's representations. D. Grace period length and interest rates. The correct answer is C. The consideration clause binds the insurer's promise to payment of the premium, and the applicant's provided statements. Reason A is not correct. Signatures relate to validity but are not the core of the consideration clause. Reason B is not correct. Assignments and endorsements are separate provisions, not part of consideration. Reason D is not correct. Grace period and interest relate to premium timing, not contract consideration. Enjoyed this practice test? Tap like, hit subscribe, and share it with a classmate. Got a question we should tweak? Comment below, we read them all. Find full practice exam books in the description or at ExamPrep.School.